Well, hello again. We are on chapter 6, page 10, and we are now going to do the entries for the equity method of reporting, and we're going to add on those intercompany profits. So we're going to use information from the previous examples with how the equity method works. I will go over this, and then I suggest try it either on a blank space there or something on another piece of paper, just so you understand how this all goes. Okay, so we're using the same information from example 1, including the schedules we did. So, January 1st, on year 4, we purchased the investment. So, only record this if it happened this year. So, we invested in the first year. This could have been year 8, in which case we invested in year 4, so there would be no entry in year 8. Okay? So watch for this. Some students just get carried away just copying these, and so they put this in, and that would be incorrect. Okay, so dividends, we know how to do that. We debit cash or a receivable if they just declared. And the investment, $90 times 90%. So net income, the sub-main net income of $16.80, and this is year 4. You can go back on the year 4 balance sheet, or sorry, income statement and check. So this is year 4, and you times it by 90%. Net income is a positive thing, so investment goes up. So it's a debit and a credit. Okay? So we already knew how to do this. Now, amortization, impairment, or changes in AD, they're called different things. Okay? So if you see amortization, impairment, that's changes in AD. Because we'd impair goodwill and we'd amortize our other assets. So let's look at year 4's amortization impairment, which is on page 5. It's also on page 8 because I doubled it. But here's for year 4. We just want for the year. Okay, so just remind yourself year 4, it's just for the year and it's after tax. So we've got negative 650, but we have to take 90%, so it works out. Remember, net income's going down in this case. It doesn't always go down, so investment's going to go down. Decrease investment. And but equity method income or loss. Now, these two are the new ones. So this is new, and this is new. And they're both on page 6. I just have to find page 6. My pile of papers. Okay, so this is year, and we need to know how net income is affected during the year. So we've got an upstream and a downstream. Let's do the upstream first. So the unrealized upstream net income is decreasing. How do we know? It's unrealized. We have to take off the profit. So that's negative. It's going down, rather. We take 180 times 90% because it's upstream. So our investment goes down, and equity method income is a debit. Now, you notice, you guys, except for dividends and, of course, the purchase, which is a whole nother thing, we're only using 2 accounts over and over. But if net income goes up, you increase investment. If net income goes down, you decrease investment. And then equity method income is just the other one. Okay? Now, the other thing that's a little bit different is from that page, we still have, whoops, wrong page, page 6. We have the downstream unrealized, so it's going to be negative. So net income's going down. So investment's going to go down. But we take the 105 after-tax number and we leave it as it is because downstream is 100%. So downstream is always 100% because it's the parent selling and NI doesn't own part of it. They own the upstream stuff and the net income, but they don't own the downstream stuff. That's all on the picks. So just make sure you know that. Okay, on to page 11, and we can go to year 5. And notice, is there a purchase recorded? No. So no purchase recorded because that was year 4. And we have the net income, again, subs net income times 0.9, and it's recorded, so we're good. Our amortization impairment or changes in AD, we have 630 on page 8. And you take 630 times 0.9. Changes in AD is always about the sub, that's why it's 0.9. Now, remember, this is not cumulative. They are for the year. So, looking at page, hang on, I've got to look for the realized, unrealized profit for year 5. So look at page 9. So all of these are on page 9. Now, I have an upstream unrealized of 90. It's going to make net income go down. We have an upstream realized of 180 that's going to make income go up. And an upstream realized of 105 that's going to make income go up. Now, my question to you is, I know when we did these calculations down here, we said if realized, you'd record them because the unrealized from the year before cancels them out. Is that true when we're doing the entries to show how income changes for year 5? No. Okay? This canceling out that we talked about, notice it's balance sheet stuff. This is income statement, so it's for the year. It is not cumulative. Okay? So we do record realized. And unrealized here for the year. So just keep that other page handy, the page 9. And notice the unrealized upstream, net income's going down, so investment's going to go down also. $90, remember it's after tax. So we take the 90 times 0.9 gives us the 81. Then we have a realized upstream, net income's going up, so investment's going up. Again, 180 times 0.9. Now we've got a realized downstream. We take the 105 and leave it because downstream is always 100%. Okay, so make sure you do these so that you know how to do them. Now, what I want to do is make sure you kind of understand the relationship between equity method that the parent uses on its little T account and how to calculate the parent's share of net income. Okay? So, here's the question. Calculate the parent's share of net income if the parent was using the equity method. On their books. So, we're going to start with parents' net income as reported using cost, which on page 8 is 7572. Then, since they were using the cost method, we have to take away the subs dividend. Oh, and this is for year 5, you guys. Sorry about that. Subs dividend, there wasn't any this year. And we have to plus or minus the balance in equity method income account. Okay, so we need the balance in this T account. So, equity method income. And remember, it's just for year because it's an income account, so it will get closed at the end of every year. So, all you're doing is posting. We've got a debit 67, a debit of 81, credit of 162, a credit of 105, and I'm sorry, I forgot this one up here, the 2965 credit. So your balance is 2584. So if it's a credit on the income statement, is that good or bad? It's good. So we're going to add 2584 to get 1015. So if you look on page 9, parents' share, dated net income, you'll find 10156. So if the parent's using an equity method, that's how to calculate the share of consolidated net income. Okay, so you have to know the entries and you have some of these little calculations. Okay, I'm going to end this and then we'll do the last section.